I think a lot of people on Wall Street, they were listening to this testimony very closely. It seemed to me, and I want to get your opinion, that Jay Powell kind of moved away from the idea that this decision coming up in July is data dependent. It seemed like a notable shift. What does that signal to you?
Yeah, that's right. It signals to me that even though he said last week he shouldn't have called it a skip, that's how they're thinking of this. They skipped a June interest rate increase. It would have taken them a lot to raise rates in June. And by the same token, or by the other side of the token, it would take them a lot now not to raise rates in July. You did not hear this idea of, well, we're going to look at the data over the next few weeks to tell us whether to raise rates at the July meeting or not. And so I think this is a skip. And he talked about slowing down the pace of increases. So they went to a quarterly pace at the beginning of the year, rather a quarterly increase at every meeting. And now they're going to a quarter point at every other meeting. So now they're at that quarterly pace that they had in the previous cycle in 2017 and 18.
All right, so there's a lot of interesting points here. You obviously wrote about this testimony. You also tweeted quite a bit. One of the things I want to focus on is the analogy of a driver pulling off the highway and then getting, I guess, on the local roads in this analogy, but still trying to reach its destination. How should investors view that?
Well, I think the takeaway here is the Fed doesn't want to overshoot. And that wasn't, the way that they were operating things last year. When you're raising rates by 75 basis points at every meeting, you're screaming down the highway saying, well, if we miss our off ramp, so be it. Now they've taken a different series of tactics here because they do have the nominal funds rate above 5%, and they are more concerned about doing more than they have to do. And you see that debate playing out right now. Atlanta Fed President Raphael Bostic yesterday published an essay saying he wants to pause. He said, we've done a lot of hard work, and now let's wait and see what that all adds up to. So you do have differences of opinion, even though you've had unanimity on the rate committee, on the rate setting committee, and the policy decisions have all been unanimous.
Does that analogy, does that run contrary to the dot plot that signaled 2 more hikes? Does that mean that possibly there might be 1 hike on that quote unquote local road and you just stop there?
No, I think it means they've gone to, instead of doing, you could think of it as they were doing 25 basis points at every meeting earlier this year. Now they're effectively doing 12.5 basis points at every meeting. They're just spreading it out by going at every other meeting. And so they're going at, you could call it 12.5 miles per hour instead of 25 miles per hour. And it'll be interesting to see, if 5-6 ends up being where they actually stop, if they do these 2 more increases, or if something, I think where data dependence comes in here is if something happens in the data that tells them your terminal rate estimate is too high or too low, the data is really going to influence the terminal rate here, and not so much the speed or the, what you do at the very next meeting.
I also wanted to talk to you about the testimony related to banking and especially banking capital. So this one quote from your story, I heard Jay Powell say it live, but it sounds even more interesting just in text. He says, I'm committed to learning the right lessons from this exercise in response to questions about the Fed's supervisory role over banks. What do you think that says about banking regulation going forward when it comes to the Fed?
Well, it means that the status quo isn't going to continue for the Fed. Obviously, Michael Barr is putting together a package of regulatory proposals, and it seems likely the supervisory culture is going to shift at the Fed. Powell was trying to sort of stay in the middle and not take a side on whether they had, how much they had screwed up versus, how much needed to change. So that was why he said, he's going to learn the right lessons here and sort of leave it at that. I thought it was interesting that the debate really focused yesterday on bank capital and not so much on, well, what's actually the challenge right now in the banking system? Are there going to be more failures? Are there going to be more mergers needed? Bank merger policy is something that the Fed has a role in. And nobody asked Powell about it yesterday. So I'll be interested to see if senators today actually talk about bank merger policy, because it's not clear really where the administration is and how much on the same page they are about encouraging mergers of troubled banks or allowing them to fail and having the FDIC come in and clean up first.
So you're leading me to my next question. What are you expecting today? Are we going to see more of the same, Or does Jay Powell kind of respond to the coverage of people like you to his testimony and maybe try to shift the message at all?
Well, I'm not sure why they would need to shift the message today. The message, was pretty clear yesterday. And frankly, monetary policy did not come up very much yesterday. So I guess today I'll be interested to see if there's more of a discussion of monetary policy and the macroeconomy. And then again, some of these other points separate from bank capital around what's happening for the regional banks right now. What are they seeing? Where could the problems be? What's the impact of higher bank funding costs as some of these banks have lost deposits? I think those will all be issues today. But this isn't like the last series of hearings in March where the Fed did come up the second day and Powell cleaned up the message a little bit. I'm not sure really what would have been left unclear yesterday. It sounded quite clear to me.